We've just been talking about how the market seems to be expecting a 50 to 75 basis point cut by March. That wouldn't leave a lot of ammo left to deal with future shocks. What message should investors take if the Fed does or doesn't do that?
Well, I think investors need to be careful here about getting too excited about the Fed. What we have here is a supply shock. If you can't go to work because of an infection or because of coronavirus, even if the Fed cuts rates 50 basis points, you still can't go to work. So this is very different from trying to induce demand by lowering interest rates and making it cheaper for people to buy goods and services. So I would just caution, I think it's a nice sign of encouragement from the Fed or other central banks if they say, hey, we're here for you, we're going to do everything we can to prop up demand, but we should recognize the limitations of Fed policy.
What's your reaction to the extreme volatility that we've seen? I mean, even before the market opened this morning, last night we were down, then we were up, then we were down, then we were up again. We got near the flat line on the Dow, below it a couple times in the S&P. Now we're pretty much at session highs.
So my take is we're still in the early days of the coronavirus story. I mean, effectively, there's a lot we don't know. We don't really know with certainty the incubation period. We think it might be as long as 14 days before a patient shows symptoms, but there have been speculation that maybe it's as long as 24 days. We don't know infection rates. We don't know the case fatality rate. When you get infected, how likely are you to die? We probably are underdiagnosing this by a large magnitude, which means we're probably overstating the death rates, i.e. you divide the number of deaths by the wrong number, you get the wrong ratio. And I think we also just have to recognize 3 months ago this disease in theory didn't exist, so mass producing testing kits is really difficult at this point. So I think there's a lot more to unfold. I think we're going to find out a lot more people have the virus. And what's really hard to gauge is the economic impact. We can try to size it in China, but even there it's very difficult. But what we don't know is how people will respond from a behavioral psychology perspective and whether they stop going to the shopping malls or stop going out to public events.
As you're talking, reclaimed S&P 3K, important psychological level. We'll watch that. The VIX is down to 36. We do have some macro desks, though, basically calling for flat GDP growth in the second and third quarter. To the degree we get rallies, how much of them are going to be ephemeral because we haven't been able to reset the revenue rate out of Q1?
I think there's a real issue here of the volatility whipsawing people. I mean, I definitely think you could argue in the short term the market was oversold, but I think it's too early to say we can call a bottom. The way I'm looking at this volatility is it's a great opportunity to upgrade some of the holdings and portfolios. So if there were some companies you really wanted to own for the last year, but they just kept getting more expensive, some of them are on sale, right? You got a 20-25% discount in some of these stocks in the last week and a half, 2 weeks. So I think there's some long-term trends you can identify where you want to own exposure to that, where you might be getting an opportunity to rotate out of something else in the market. So I'm looking at this as a rotation opportunity rather than this is your chance to back up the truck and load your cash into the market.
Ron, I'm wondering whether that drop that we saw last week, and hate to talk about it too much in past tense because anything could happen at any minute here, but was that a panic or was it a sobering up, right? Because valuations were generally, in the markets pretty high already. So should investors, when we think about things getting back to normal, is this level more back to normal or is where we were more back to normal?
No, I think it was more of a sobering up. I think the market had gotten a little ahead of itself. Valuations were stretched in a number of sectors, and the market had been ignoring coronavirus for weeks, right? So we saw this happening, and as long as it was confined to China, people seemed to be willing to ignore it and say it's a problem in China. Well, the reality is China is 17% of the world economy, so we should never ignore what's happening in China. And it really took it spreading into Europe for people to actually have kind of that come-to moment and saying this is really important. So I do think it's actually the right adjustment for the market. Maybe it happened really abruptly. It was violent. But I do think that people had to start paying attention, and we finally did.
Does it change the way an investor, a global investor, should think about relative value in the U.S.?
I think this is one of those things where it's hard to make a broad generalization. I think this is just an opportunity to come back and look at the fundamentals of each individual company. So the way I'm looking at it is this exposes some of those companies that are highly levered, where you're waiting for cash flow, hopefully 5 to 10 years from now. If the risk of recession has gone up materially, those companies don't do particularly well, whereas some of the other companies with strong balance sheets, talented management, and ability to compound earnings and capital over time have basically been put on sale.
So it's a boon for value. I mean, that long-awaited value trade. No?
I'm not going to say value versus growth. I think it's basically an opportunity to buy higher quality companies at a lower price. if anything, actually value has underperformed growth in the last couple of weeks. And I think if you think about that, a lot of the value stocks tend to be more cyclical. You've got your financials, materials, industrials. If you're actually having an increased risk of recession, those stocks are more susceptible.
Are you taking a harder look at balance sheets now?
We always look at balance sheets, so I think we're always focused on the balance sheets and the fundamental, but I think you should be doing that. And we've seen some of the credit spreads in the high yield market widen out quite a bit. We've seen some interesting reversals as the U.S. 10-year Treasury got toward 1%. Greek 10-year yields 2 weeks ago were at 90 basis points, and now they're at 140 basis points. So the market definitely is recalibrating risk and repricing risk right now.
This started in China, where a lot of the goods that are made are relatively easy to count. You know, they're coming out on shipping containers. You can see whether they continue to do that or not. We hope, of course, that this doesn't have a major spread in the U.S., but if it does, how would you advise investors to think about the supply of knowledge goods? Software that maybe isn't getting coded or checked, people who aren't able to be as efficient as they might have been because perhaps they're working remotely in teams that work better together. Is that something investors should even consider, or do we have to wait for earnings reports and things like that many months down the line to start to get a handle on it?
I think what you're highlighting there is some of the really tough factors to try to quantify, right? I mean, how much time are people spending in the office talking about coronavirus instead of doing their job, right? Even if you can get to work, there's definitely been a productivity degradation from this situation. And I do think you're right that there will be issues of people who are working from home perhaps being less productive. That's largely on the margin, I would argue. What I'm more worried about is people who can't get to work. And so if you think about the most susceptible people or vulnerable people in an economy, it's usually those hourly workers, where if many of us aren't going to the office and we're telecommuting, then you're not going out to lunch near your office, you're not going basically using a taxi in New York City, and the people who you're not basically providing or using services from generally don't get paid when they're not working. And so I think this kind of comes back to how you think about the economic impact of how much of this is demand destruction versus delayed consumption. And I think that demand destruction is actually very real. And we're definitely seeing that in China, by the way, where I think if you look at the Baidu Migration Index, only 58% of the people from Tier 1 and Tier 2 cities who left for Lunar New Year have returned home.
Never made it back.
I mean, this is an incredible hit to demand. And, you read the articles about the local noodle shops where they're trying to figure out how to keep the business afloat.
Right.
I think,
and have a month's cash at best.
Exactly.
Right.
It's a very tough environment for small business and for companies with more leverage, less cash. And so I do think we have to think about all those ramifications for the economy and for security selection.